Hello and welcome to Switzer Investing. I'm Paul Rickard, filling in for Peter Switzer. Well, while Peter's away, he, of course, is still writing every day in the Switzer Report and the Switzer Daily. And, of course, both Peter and I have been talking a lot about just how expensive banks are. We've been saying that now for a couple of months, and the bank prices keep on going up. But at some stage, that'll stop. But the question I've had from many investors, and by no means are we suggesting you sell all your banks. We're more about lightening and trimming. But the question is, what do you invest in? If you want to sell your bank stocks or sell part of your bank portfolio, what are some of the stocks you can buy in what looks like to be an overall fairly expensive market? Well, joining me today, I'm going to talk to both June Bailu. June is the senior in portfolio manager with Tribeca Investment Partners, and Raymond Chan from Morgans, and ask them that very question. What do I buy if I sell my bank stocks? Joining me now is June Bailu. June, of course, is the senior portfolio manager with Tribeca Investment Partners. June, welcome to the program.
Thank you for having me, Paul.
Now, we've been advocating to some of our clients and others that it was time to lighten up a little bit on banks. And I guess we've been saying that for a bit of a broken record now for a couple of months, and the price of bank stocks keeps on going up. But at some stage, I know we're going to be right. I think the question many investors have is, if I sell part of my bank shareholding, what do I invest in? Particularly when, I guess, resources aren't looking as crash hot at the moment as just given the China outlook. So just wondering, where do you see as the opportunity to invest at the moment? In particular, is there something in healthcare as a starting point that you like?
Yeah, absolutely. Thank you. Thank you for asking this question. We're sitting there very similarly. We still hold some banks, but it is very hard to be certainly buying banks at this level. And then given how much they performed and given the earnings outlook, look, all of their earnings will go backwards. They still got really strong balance sheet. They will pay, good dividend, but it just earnings going backwards. So surely there's something else we can buy. So some of them name healthcare you talk to. Actually, healthcare sector doesn't look too bad. You've got the CSL that does the double digit for the next 2-3 years. It's trading at above about that 25 level. You've got ResMed actually cheaper at the low 20s sort of level. It's trading on double digit earnings growth. And then even you got Cochlear is coming down. It's a bit expensive, but Cochlear has had a bit of hiccup in terms of earnings. But we all know this is a high quality company. You buy them on the dip. Would have made a lot of money over the last decade. Buying dip on those businesses. So these businesses actually look quite attractive. From funding, selling some of the banks they're going into. And the earnings are very defensive. So even if we have a more severe recession or severe slowdown, these businesses' earnings aren't going to be impacted. So so it's very defensive to start. There's a couple of other.
So do you worry about both, I guess, ResMed and CSL to a lesser extent have been impacted at times by these magic sort of obesity drugs that might make the market for sleep apnea products a little less narrow the market, because there won't be so many, I guess, obese people that have breathing difficulties, and in CSL's case, potentially, the fear about their kidney treatment business may not have quite the demand. Are you worried about the impact of those drugs, or is that something just that's market hype that comes and goes and we learn to live with?
Yeah, look, I think there's two things. So, the one good thing is that markets already reacted to the possible bad outcome, right? So share price literally lost, I think they lost half, within a month last year when all these drugs came through and about those promising outcomes. So, bad news has been priced in. So we know there's bad news. People are expecting those bad news. And second of all is that we actually don't know if the bad news that's been priced in is going to take effect, at least not for another decades for it to take effect. These drugs are so new that, regulators are still working out who can take those drugs, who can't. And at the same time, there's also a good debate that, now actually getting a bit louder, that does that actually increase the sleep apnea potential addressable market? So people more aware of it. Actually, there's more people will be using, the sleep apnea products as a result of it. So, there's a very active debate at the moment, and it's very hard to call for the short term term. Certainly what we see is that there's bad news in the price near term for at least for the next few years, earnings growing great. And the real impact from those drugs is really going to, take another decade or longer to take place.
And of those three healthcare companies you mentioned CSL, ResMed, and also Cochlear, sort of relative ranking from you? I mean, would you look at all three? I mean, just trying to get a sense on what you think looks most attractive at the moment.
Yeah, look, I would think ResMed will stand the first one. It's the cheapest amongst the group. And then I think next one down for me is more Cochlear. I know it's more expensive, but Cochlear has much structural higher growth profile. And plus, recently, the hiccup I talked to in terms of earnings shortfall has created this attractive opportunity. So for me, that's number two. CSL, I just think that's a compounder. It's good to have in the portfolio, and it will grind higher. But that initial sharp rally probably is done. They kind of just going to grind higher.
Okay. What about a stock like Pro Medicus that doesn't seem to want to come down? That's trading at some pretty stratospheric. I don't know if I can't even pronounce it. It's trading at a crazy multiple. What do you think about Pro Medicus now of over $150? I think it is.
Look, to me, that's a buy. So, for me, it's so my portfolio sits with the defensive bucket, value bucket, and then there's your growth bucket. You've got to have some stuff in the growth bucket, because these companies will grow in 5 years much, much bigger than every other companies because they grow much slower. So, to me, in that bucket, you've got the Pro Medicus, which just seems to, like you said, keep winning share. And every time they win share, with the more their customer use, the more they earn because they clip a ticket sort of way. And they, addressable market is enormous, and US is dominant market, but there are so many other markets that haven't even yet to focus on. So incredible amount of opportunity for us. That's a buy. But in that growth bucket, there's a few other companies, right? Like you got the Life 360 doing incredibly well. A lot of potential, for advertising revenue. Recently just signed up Uber, and I think it's got a lot of potential. We got Zip. Again, it's coming back from death, and it's doing really well in the US there. So, so there's a lot of company in that bucket, but they all expensive. So, so I just think in the portfolio, you got to have a bit of everything.
Sometimes when stocks are expensive, you've just got to buy them, right? Because they don't necessarily cheapen out. Okay, let's go. Let's look. Well, you mentioned that it's a combination of the growth bucket, the defensive bucket, and also I guess stocks are a bit more in between. But just talk about the defensive bucket. Let's say you've full to the gills on healthcare stocks. You want to just ease up a little bit on the banks. You don't want to take perhaps as much risk as some of the stocks we've been describing. What about in the defensive category? What stocks would you look at in that area?
Yeah, so in the defensive category, I would name the likes of Bramble, Endeavour, and Treasury Wine. So, actually, Bramble itself actually has reported incredible numbers, double-digit growth, teens multiple, cash conversion incredibly strong, doing buyback, doing special dividends. So, it's got so much momentum behind it, and it's very, very defensive. Leverage to the FMCG sort of volume, and it is really it's a really it's got growth trajectory that we can see for at least the next 18 months, if not more. So, we like that one. Treasury Wine is a story we've been pushing for a long time. It just finally started to gaining a bit more momentum when wine finally going back into China, which was because a high tariff wasn't going in. Now it's finally going in, and it's giving them a really good base to improve the mix, improve pricing, and really getting that earnings growth leverage to come through, operating leverage to come through. And I do think next 12-18 months things are going pretty well as the wine started going back into China, that luxury end. It's it's a lower end, cheaper end wine is struggling somewhat, but the branded is very, very strong. And Endeavour is another one. It's a bit of a fallen angel at the moment, but it's got good assets. It's got those, Dan Murphy, one of the best. There's the best alcohol retailing. Things slowing somewhat, but I think the hotel and hotels business is actually turning around, and even Victoria starts showing positive growth. So I think for this business, next 12 months it will show a little bit of earning growth, but moving forward it will show pretty decent growth for a very, very cheap multiple.
Is the market a bit sort of schizophrenic on Endeavour? I remember at a time when it got almost to $8, it went over $8. Now it's sort of below $5 or just touching $5. No one seems to like it, but it doesn't to me seem like much has really changed in their business, or are there other issues that just haven't come to the surface as well, that the market's taken a much dimmer view about Endeavour's prospects going forward?
Look, a market is schizophrenic. A full stop at the moment across the entire market. Seems to want to buy anything that can grow and put a huge multiple on it, like you said, with a couple of those growth company. And if
Mm.
if you have any issues near term, no one wants to touch it. It's kind of in that bifurcated area. So that's where we see the opportunity. Nothing's changed. If anything, I actually think management has put this cost out program target out there, and I do think they are well on track to do that. Compared to when it first listed, and every part of business is actually doing quite well. And then now they're washing through the tough period the hotel experienced in Victoria, where the environment was so tough, and finally it's now reporting positive comps. So to me, things are showing green shoots, and meanwhile the demographic business is still going, does what it does, very, very defensive business. So, I just think at the moment that whole staple area is lacking some sexiness. The investor like these are fun things to go for, but
that's the right word for it. Sorry, Jude.
That's
Yeah.
right, but
And
that's what they
is Woolworths now has I think has sold its last parcel of Endeavour, so it's out of the Endeavour Group totally. I assume that's got to be a positive for the stock, doesn't it?
Yeah, that's right. I surprised the share price hasn't rallied away, because that's it, right? So Woolworth made it very clear they are seller, and it's all done. And share price actually stabilizing somewhat. And from here on, the company is looking pretty good.
Yeah, I think that's a really low risk way to enter the market, Endeavour Drinks. I just don't see quite a lot of downside.
That's right.
I guess the problem they have is that that the overall market consumption of alcohol is plateaued. It's not growing. So whether that's probably a long-term trend as people look to want to acquire more healthier type drinks, and the other issue, of course, is just the gaming and the poker machines, but which of course is a negative for for some investors, but it's still the dominant player in that part of the industry, and it's certainly the market leader. So I think
That's
it's
right.
near $5. It looks really cheap.
That's
Okay,
right.
look, anything else just before you to wind up that's really taking your fancy at the moment?
Just trying to think anything else that kind of interesting in the marketplace. Look, I think there's a couple of other companies' results coming up as well, right? So aside from the also coming up, that's Zero.
Hmm.
Hasn't reported yet. Kind of lost a bit of people's attention because people was focusing on the result periods. And every other tech company has rallied away. This one sort of left behind. So we know when the result comes through, there's a bit of a boost to come through. I think that one looks very interesting. And I think it's the consumer discretionary space will be interesting, right? So we've been actually quite positive this space, and they all rallied away. So I'm kind of just hoping when the market volatility picks up, it gives you buying opportunity back into those names, especially the market leader like JB Hi-Fi, because I do think the next 12 months things will look much better for the retailers.
And are you worried about sort of just the US now getting towards the election, just September, September, October, always tricky months. Is that
Mm.
sort of impacting your sort of thinking at the moment? Just being a little bit careful, or you think that's one of those things we'll just sail through and keep heading north?
Yeah, look, it's always for me. I often use these as buying opportunities, and it's buy on dip. Now seems to be a really good strategy, simply because yes, we got election coming up, but post that we're into a rate cutting cycle now. So Australia might be a little bit longer. Say start next year or late this year. Still we're heading into a rate cutting cycle. It's very good for equities, and so you got to really just start picking up some of the companies as they as they fall, and it might be a month early, might be 2 months early, but this is when you actually pick up a lot of those companies, get really good return in 6 months.
Okay, well that's terrific. That's June Bailu. She's the senior portfolio manager, or the lead portfolio manager, I should say, from Tribeca Partners. June, thanks for joining us.
Thank you very much. Thank you.
Joining me now is Raymond Chan. Raymond, of course, is the head of the Asian desk at Morgans. Raymond, welcome to the program.
Thank you, Paul.
We've been talking a little bit about what clients can do if they're looking to perhaps lighten up on their bank holdings. And by no means are we suggesting you sell all your banks, but just lighten up a little bit. But the question that I keep getting back from my clients, and I'm maybe you're getting the same, is what do I buy if I sell banks?
Sure. I guess first of all, when we look at the banks, they certainly perform really, really well for the past 2 years after, I guess, very poor few years with the banks, especially after the Royal Commission. Now, with major banks like Combank, they're trading on well over 2 times of their book, almost 3 times. Certainly, that makes sense to trim down the holdings. But of course, with the banks, because of its big index weighting for the ASX 200, trimming seems to be a better option than selling it out.
Yeah.
Especially for those clients who still want income. There's certainly a number of ideas that we like at the moment. If we purely look at the ASX 220, the top 20 stocks, where the value coming from at the moment, certainly we look at the like of resources stocks. However, there's certainly people concerned about, how China is growing, how's the commodity price is moving. So people worry, but I certainly see a bit of value in the resources stocks.
Yeah, so you see some value in BHP and Rio and maybe Fortescue. Is that what you're...
In particular, I think BHP seems very interesting at the moment. Remember, everyone's talk about a potential September Federal Reserve rate cut. History suggests that, at the beginning of the rate cut, we will start to see a little bit of the US dollars weakness. Yeah. And remember, the commodity price usually priced in US dollars. That surprisingly will lead to some sort of commodity bounce back. Probably not immediately, but over the next few months. And a lot of concern, yes, we understand, is with the iron ore price at the moment. But with BHP, only just a bit over 50% of their earnings come from iron ore. And recently they talk about the cost price is around $18 per tons, versus, currently trading around the $90 to $100 per ton. So there's still a good profit to be made in that division. And certainly with BHP, they also diversify into other area, which, we think looks pretty interesting to us.
So let's say that's all good, but client says, look, I'm full to the hill of PHP resources. I've been buying them on the way, but they keep on going. The trend's not my friend at the moment. Let's just look outside the resources sector. So, but I still want stocks that reasonably, have reasonably good defensive attributes, a bit like some of the bank stocks, because we know they pay a reliable dividend and doesn't vary much, and I can put that away into the portfolio and measure what sort of income I'm likely to get in the next 12 months. What are some of the other stocks you'd look at in that category?
If we look at the reporting season, Paul, I'm absolutely with you. I look at the top 20 company, even if they have the result a little bit below market expectation, they actually collectively, they outperform the market. So the opportunity, I think, is still good for general investors is to look beyond the top 20 and extend it into the top 100 stocks.
Right.
So the top 100 stocks, the 21 to 100, they still give you sufficient liquidity, and normally those are the very big company. And there's one I particularly like that fit into what you just described is the Lottery Corporation, TLC.
And that came out of Tabcorp. You want to just give the history of what the Lottery Corporation does and then perhaps why you like it?
Actually, that TLC was a very, very old company. It established back in 1881. That was the tartar sauce. And obviously, Tabcorp acquired tartar sauce and become a bigger company. And then after a number of years, the management decided to demerge this business. So you're absolutely right. TLC was demerged from Tabcorp, but when they demerged a few years ago, they also inherit quite a bit of debt from the merged entity.
Right.
So the interesting about TLC is, yes, it's a defensive business because they got the long-dated license to run your everyday lotto and keno. So with lotto, that's included Powerball and the Oz Lotto. Very familiar business, very defensive business. And of course, you will need to renew the license, with the most recent being, the Victoria license got to be renewed by, I think, 2028. This lottery business has been a very, very long, old business that remain today very defensive. So the reason I talk about that debt is the reason the lottery corporation won't be able to pay out a lot of dividend at the moment is because they need to prioritize paying down their debt.
Yeah.
However, we have enough evidence to suggest they are doing it exactly that. So over the past 2 financial years, they pay down debts meaningfully. I think every year they pay down about $100 million worth of debt.
Yep.
And the management also showed to the shareholder, once they gradually pay down their debts, they will increase the dividend payout. So yes, today, they're paying a bit over 3% in dividend yield. However, this is the one with a defensive business with the ability to pay more dividends down the track when the debt eventually pay lower.
And if interest rates fall, does that help the lottery corporation?
Absolutely, because of the interest they pay on debt at the moment. So with the lower interest rate, that certainly help. And also some people concerned about the economy at the moment. Interesting with the lottery business, if the economy is bad, the history suggests actually they do more, they do better business.
I mean, this is for most people, having a flutter on the lotto is not a big expenditure, but you're saying that perhaps tougher economic times leads to maybe a little more sort of looking for the silver lining somewhere, perhaps. But it has, I think, historically, it's proved very resilient to the economic cycle, hasn't it?
That's true, and I guess that was one of the attraction point for initial takeover of Talasource by Tabcorp. To combine the two together. So obviously, we're now seeing a bit of challenge with the Tabcorp business. However, if we look at the recent result come out from TLC, the lottery corporation, that result was ahead of market expectation. That gives us further confidence to have TLC to be part of our portfolio.
So shareholders can basically sort of factor in almost a 4% dividend yield, which close to 4%?
It's close to. So, but it will require them to, pay down a little bit more debt before they can reach that 4%. At the moment, it's between around 3.5.
Right. Well, Commonwealth Bank is yielding actually less than that, right? So it's sort of we compare it. Is there any other stocks in that category that sort of that defensive that in that sort of stocks, sort of 20 to or 21 to 100 that you like? You mentioned Lottery Corporation.
Let me talk to another one, which the recent result was meet the market expectation, but they sort of miss the FY25 guidance.
Right.
And I can explain. This company is Sonic Healthcare, probably one of very well-known companies.
So that's a big pathology provider. Douglas Hanley Moir, or is it Australian? One of its Australian brands, but I think it's got more business outside Australia than it does now inside Australia. But
exactly, with recent acquisition, they're actually now the number one pathology in Switzerland and in a number of European countries. And the way we look at Sonic is it's quite unusual to hear profit disappointment from Sonic. I think a few months ago there's one profit disappointment, but before that we have to go back like a few years, almost 10 years before that happened. With Sonic, remember they benefit the most from COVID because of the testing requirement, and because of that they expand their facilities there. So, however, we now in the post-COVID world, and people actually don't want to go to do any testing because they have done enough. They're left with significant higher overhead costs. That result in profit below market expectation. However, we think Sonic has now readjusted the cost base. And importantly, with the recent result, we saw a bit of consensus downgrade after the result. So the bar for FY25 is become lower. Yes, I have heard many times downgrade usually come in free. We only just have one downgrade. However, we have to look at pathology business itself is quite defensive. It's more about the cost they need to adjust. This means we're going into Sonic now on a projected yield of around 3.8%. They're not the balance sheet remain pretty strong. They're not having a hopefully high debt situation. So they can certainly do better if they can prove to the market, especially during the AGM, they say, hey, the outlook may be a little bit better.
Yeah.
That could be some upside for investor.
Okay, so there's two companies to consider, both quite defensive, both paying a reasonable dividend yield, and both hopefully be able to improve that over time. So that's Lottery Corporation, which is TLC, and Sonic Healthcare, which I think is SHL from memory.
Exactly.
So two things to consider. You added them to your BHP, but there are stocks out there that you can look at if you're trying to trim your bank holdings. Raymond Chan from Morgans, thanks very much for joining us on Switzer.
Thank you for your time, Paul.
That's it from Switzer TV Investing. Don't forget to subscribe to the Switzer Report. Go to switzerreport.com.au. I'm Paul Rickard. See you next week.